Good morning. I'm really delighted to be here. We came here, Sian and I came here 2 years ago and held a panel on the policy and particularly the donor perspective on assistance for hydrocarbons producing developing countries. And it's really wonderful to follow that up because we took a lot of ideas from that meeting back in 2016 and we put them into this report, which is outside, Carbon Risk and Resilience, How Energy Transition is Changing the Prospects for Developing Countries with Fossil Fuels. And I hope that you'll pick up a copy outside or check it out online. So we were really interested. We heard a lot of noise in the UK and in the States and Europe about this issue of stranded assets, and it often came up yesterday, unburnable carbon, the carbon bubble. And we found it to be a very northern dialogue, an OECD dialogue amongst a predominantly finance or investment-oriented community. And it's certainly based on our background in working with developing countries and with national oil companies and other minerals, other policy institutes within the minerals space, that these terms didn't resonate, and the language that they used on governance didn't really translate into these dialogues at all, and yet they were really intimately connected, because if you are basing your growth and development around your fossil fuels development, then the potential of decline in those markets, the potential of a carbon budget and a finite period of value for those materials is going to have a big impact on your economy. So today, I'm really, really delighted to be presenting some new modeling. We are looking closely at the impacts on the economies of producing countries of energy transition related to decarbonisation. And first we will hear from my colleague and co-author, Sian Bradley, who works with me at the Energy, Environment and Resources Department at Chatham House, who will do a bit of scene setting on how how carbon risks might translate in a developing country producer context. We will then turn to Isabel Blanco from the European Reconstruction and Development Bank, who has been working closely with ministries of finance in Kazakhstan and Egypt to hear particularly why EBRD was interested in investigating this issue of carbon risk and what they found. We'll then have Baltazar Solano Rodriguez from the UCL Energy Institute, who has been working with the Inter-American Development Bank on a really interesting study that comes out early next year, looking at the fiscal risks in the Latin American countries. And then finally to Vibhuti Garg from the International Institute for Sustainable Development, who will talk about India and coal and how that transition could play out and some of the challenges involved in that. So I think we have a very rich spread of countries that we're going to cover, and some of it will follow up, I think, on Ivetta's wonderful presentation yesterday around the challenges facing the BRICS countries. So I hope we can go into a bit more depth in the discussion following on from that. So, Sian, over to you.
So first of all, thanks very much to Michael and Harry and everyone for having us back again to provide you with an insight on what we've been working on since and how we see the debate around carbon risk developing for emerging economies. I'm going to say a few words about the prospects for developing countries with oil and gas and how they're changing through the energy transition. And I guess the first point to make is that the issue of carbon risk has obviously risen very rapidly up the international agenda since the Paris Agreement. We heard yesterday that although there is disagreement over the precise pathway, that we do all broadly agree that the transition to a decarbonised economy will have profound implications for the value of assets and investments over time. not only in the upstream fossil fuel sector, but also in the power sector, linked downstream industries, petrochemicals, plastics, fertilizers, etc. And through industry-led initiatives such as the TCFD, there's now growing consensus on the importance of testing long-term resilience against a range of 2-degree futures and an emerging set of tools and metrics with which to discuss risk. And equally, there's a growing recognition of the need to consider and prepare for the wider fiscal stability implications of transition. So we're beginning to see central banks in the UK, the Netherlands, France, regulators looking at the potential for forward-looking carbon stress tests, for regulatory responses, a shift from voluntary to maybe mandatory climate risk disclosures, and really highlighting the need for further risk into the relationship between climate scenarios and economic impacts. And obviously some of the most established oil and gas producers, such as Saudi Arabia and Norway, are also beginning to look to a future beyond oil. Now, developing countries really haven't been part of this narrative to date, and that's problematic because when we look at least developed, low-income, low and middle-income economies, at least half are either currently producing oil and gas or they're exploring for oil and gas and hoping that it might provide a driver of economic development. That number actually rises to more like 80% of least developed and low-income countries. And these countries are also among the most vulnerable to disruptive shifts in energy investment. They're far less diversified, they're more reliant on the trade of raw materials, and they also typically don't have domestic financing capacities, so they're reliant on foreign direct investment and external debt. And at the same time, they have much lower institutional capacities and lower ability to incorporate assessments into policy making. So we set out with the Carbon Risk and Resilience Report to really look a bit more closely at how carbon risks translate in a low-income context. And I'm going to show one slide today, and that's it. I think in the first instance, it's really useful to review the primary linkages that tend to form between the fossil fuel sector and the wider economy. And this, I hope, sets out the kind of the scope of the discussion here today. First, obviously, there are investments and revenues that fossil fuel projects can generate, which in turn can help support budgetary expenditure, capital expenditure, long-term savings, and which can fundamentally change the terms for a country's access to finance, where guaranteed, or the prospect of guaranteed cash flow effectively acts as a credit enhancement. And second, there is the prospect of direct fossil fuel flows to the energy sector, to the domestic economy, either through the government's share of production or through buybacks from the operator. And this is primarily, supports energy generation, but also sometimes provides feedstock for related industries. And of course, there are also a range of local content, employment benefits that can be generated directly and indirectly through the sector. Although, as some people pointed out yesterday, these tend to be much more stated where coal development is concerned rather than oil and gas. Now, traditionally, all of these linkages have been seen as the key to driving economic development from the sector. But when we start to look at them in light of decarbonisation trends, these linkages increasingly look more like carbon risks or the kinds of carbon entanglements that we were discussing yesterday. They change the value proposition, what developing countries can expect to gain from developing fossil fuels in the coming decades. And they also have a range of wider implications, the kinds of debt and dependencies that carbon-intensive infrastructure can lock in, and also the structural features of a carbon-intensive fossil fuel-led economy and the implications that these might have for sovereign ratings, the cost of borrowing, positioning for climate finance, so on and so forth. Now, obviously the materiality of these risks are a highly context-specific thing. And in order to begin illustrating how some of these risks might play out in practice, we, along with our co-author Steve Pye from UCL, who's somewhere in the audience, started creating a series of very simple country scenarios for Ghana, an early stage and expanding oil and gas producer, and for Tanzania, which currently has small-scale gas production but a much larger offshore discovery. And we started exploring fossil fuel supply, demand, and revenue trajectories out to 2045 under a range of different climate scenarios, including an NDC scenario, so compatible with current Paris commitments, a 2-degree scenario, and also a no CCS scenario, which was our much more disruptive scenario where the available carbon budget is effectively halved. And they highlight a number of challenges that have broad relevance for all developing fossil fuel producers. And I'll just touch on 3 very quickly. The first, perhaps obvious one, is that the most constrained climate scenarios have a particular impact on government revenues. You can see particularly reduced government revenues. Ghana's annual and cumulative oil revenues look about 50% lower under a 2-degree scenario, and around 65% lower under a no CCS scenario. And the difference for Tanzania, where gas revenues are concerned, is even more stated. It's around a third lower under a 2DS scenario, but something in the region of 80% lower under a no CCS scenario. And this is largely because of the sensitivity of gas to CCS in the power sector. So it comes with the caveat that it could be understating the disruptive impacts on oil. Now, while the challenges of managing energy dependence on volatile export revenues is not a new thing, climate-related shifts are likely to exacerbate the challenges and the many drivers of supply and demand and price and volatility. And it calls into question a lot of fundamental assumptions that have underpinned advice to the sector, like using the boom years to prepare for downturns, and also what is commercially viable production. So with cost curves changing and the likelihood of increasing competition between producers for the remaining available carbon budget, it's reasonable to expect that higher cost marginal producers are at a distinct advantage, and those still exploring for fossil fuels at this stage at a particular disadvantage. So there's a strong case for governments to be looking at long-term downside scenarios and the worst case for fossil fuel demand and for revenues, particularly where their economic development plans are based on the development of these industries. The second key point is obviously that under the most constrained climate scenarios, the time frame for diversification looks very, very different. So if you think of diversification away from the sector as being the litmus test of successful fossil fuel development, if your plateau in production and your prospects for generating more investment into the sector look increasingly challenged, and you're looking at 10 years instead of 20 or 30 or 40, that obviously becomes a far greater challenge, and it calls into question a lot of traditional industrial development pathways. And a third point is the kind of path dependencies that fossil fuel development tends to set in motion in terms of the energy systems and the industrial development that countries often follow. And what generally happens is that countries face a choice between exporting less and diverting more to the domestic economy, and so reducing their foreign exchange inflows, or becoming import dependent, so having increased foreign exchange outflows. So that can act as a real current account stress. So in this context, obviously, greening domestic demand and creating the most flexible low-carbon infrastructure and industries looks like a potential pathway to really mitigating some of the challenges that are presented by fossil fuel-driven pathways. Now, in terms of policy responses, there are 3 broad areas that emerge. First is around the need to broaden country perceptions of carbon risk and go beyond a fossil fuel sector framing, thinking about the carbon intensity of production, the potential for fossil fuels to displace higher carbon sources of fuel in the economy, for instance, where there's oil being burnt in the power sector or firewood or charcoal, and looking more intensely at sort of economy-wide transition risks in the way that the more established producers are beginning to look to, and in the way that advanced economies are also considering fiscal stability as a wider challenge. It also means looking at the development of key capacity capacity across key areas of governance, particularly economic governance, energy and industrial policy, and in the upstream fossil fuel sector itself, and we can get into that in the conversation. And it also means thinking about the role of development assistance. Obviously, the major multilateral banks and development agencies are realigning their commitments with the Paris Agreement and reconsidering their support to the fossil fuel sector. And the World Bank's announcement that it would stop financing upstream oil and gas from next year is probably the most prominent of those. But that's obviously part of the puzzle, but there's a real need to really engage with the specific challenges that developing countries with fossil fuels face, whether it's thinking about alternative development pathways or actually addressing some of the structural barriers to transition. And that requires some new thinking. So I think Isabel's going to pick up on some of that.
Thank you very much, Sian. And that segues really nicely into Isabel's intervention, because you actually work in an MDB and you have very direct experience of working with producer countries. Isabel.
Thank you. So my name is Isabel. I'm the lead economist of the European Bank of Reconstruction and Development dealing with green economy transition. I focus on the economic assessment of projects and policy directions within the bank. If you are not very familiar with the EBRD, we cover quite an heterogeneous spectrum of countries. The former Soviet Union countries and communist countries within the European Union, plus a number of countries in North Africa, 36 in total. They are very different socioeconomically and also in terms of energy endowment. Because the EBRD is doing a lot of thinking about how to link our activities with the green economy transition, with the Paris Agreement and so on, the bank has put a lot of emphasis in increasing finance towards green assets, and we follow international definitions there. About 40% of our business every year is channeled towards green activities. Now, in certain countries, we realize that the green economy transition and lower dependence on fossil fuels may have a negative impact on their economic well-being. Countries like Kazakhstan, for example, 75% of their exports rely on the sale of oil and gas, particularly gas. So a few years ago, we thought we may need to start having a conversation with these countries and discussing how do we think this is going to impact them, and there is a lot of uncertainty depending on how commitments are being implemented and the cost of alternative technologies and so on. So to start having the conversation about the impact, and then to have a conversation of what can they do in order to minimize the negative impact, the likely negative impact of these changes. And this is a difficult conversation because basically we go there to see ministers of finance to tell them that the fiscal impact of the green economy transition is going to be that they lose 50% of their revenue by 2040 in comparison with the baseline. And I had to do that because that's part of my job. And in the beginning, I had a conversation with my boss and I said, look, I don't think it's a good idea because, we may even trigger that some of these countries may want to retreat from the Paris Agreement because they realize now how difficult this is going to be for them. Why are we even raising the issue? Let's focus on the positive story of renewables and so on. But in the end, I was more or less told that we needed to do this. And it's been a very rewarding experience because actually the acceptance and the degree of understanding of the governments, and it's a limited number of governments so far, but with the governments we've had this conversation is much better than I had initially expected. So, for example, in Kazakhstan, this country has already had a taste of what it means to have a significantly lower earnings than expected. And this is because in 2014 there was this big drop in gas prices that they were not expecting. So suddenly the revenues from exports almost halved in a couple of years. And that was a strong message for them and an awakening that they need to start diversifying and thinking of alternatives for their investments. So the conversation actually has been much better in this respect because they were already familiar with the topic and they thought that it could affect them. One of my key messages whenever I go to these countries, because these countries are not really interested, for a good reason maybe, in environmental issues. For them, the priority is economic growth. So if we go there saying, temperature is going to increase 2 degrees in 2040, we don't do something, this and that. In Kazakhstan, there's minus 40 in winter, so, they look at me and they don't really understand what I'm talking about. So the narrative that we need to have with them, or that we try to have with them, is about economic opportunities. This is happening at the global scale. You are a price taker in a market and you need to adjust to the new changes that are coming. And this could be climate policies, or it could be technological developments, or anything else. So even if you don't strictly believe in the challenges, or do you think they are not important for your priorities, the climatic challenges, still you need to do something because this is going to happen to you no matter what. So this is something I learned. Another tip that I've learned over the years is that these countries are normally much more interested in the local pollution impact than in climate change. Many of them have a lot of coal for internal electricity generation and for district heating, with very low quality, or relatively low quality. And this translates into a lot of particulate matter. Places like Almaty or even Astana, not to speak about Ulaanbaatar in Mongolia, these are amongst the most polluted cities in the world. So when we tell them that diversifying away from fossil fuels, particularly in the case of coal, is going to reduce local pollution, they listen, because there is a growing concern also from the local populations. So we put a lot of emphasis in the co-benefits. Another interesting angle that I saw is that when we start talking and, we go there and we say, some countries are taking the lead and they're doing a lot of things about diversification, and look at Norway, and look at the UK, and look at the US. And they look at me and they say, what's Russia doing? Because countries, it's not necessarily they look into the best performer in the world. They have their comparators and they compare themselves against what they think are their peers. So when we go to Central Asia, Russia is the natural leader of the region. So they want to know, they want to understand what Russia is doing, or they want to understand what China is doing. So using examples of us, Western countries sitting here in Oxford, may not be the most appropriate message for these countries. And this is the importance also, in my opinion, from the regional leaders. If there is a regional leader, a well-regarded country in a certain continent or a region, others will look up to them. And that, for example, is the case of Russia in the region that I cover. What else? What did we find in terms of studies? So, for example, in the case of Kazakhstan, we went there with a mixed message, which is, yes, you are going to have less income than it would be if climate change agreements did not exist. But up to 2040, we don't see a lot of risk of stranding in the case of gas. And this is because the extraction costs are relatively low in comparison with the world average, and also because gas, as of today, is not as stranded as coal or other assets that we are discussing here. So for many countries, at least in Central Asia, they do not export coal. They use coal internally, and they can use it no matter what the global policy is. Whatever they decide, they will do. And it is, as I say, more a question of local pollution than international agreements. They are bound to international agreements on the commodities they sell, and these are oil and gas. So the message we send them there is, you need to be careful. Gas is going to become less and less interesting. Prices will probably fall over time, but this is not immediate. And then we speak about the window of opportunity. And we tell them, you have a few years still until these impacts will become more visible. So it is time for you now to start thinking how you are going to diversify the economy. And then they ask, so how do you think we could diversify the economy? And to be very frank, it depends on the country where we are, but in some countries, the diversification path is not very obvious. I was in a chat yesterday in another session about coal transitions. The coal transitions in Europe are normally in complex economies that have many different growth paths, and coal is normally a small sector with a limited number of workers there. And the fiscal impact sometimes is more on the negative side, meaning that the government has to pay a lot of subsidies rather than being a net creator of wealth as of today. But in other countries, the message is difficult because if they ask me, it's not obvious how they can diversify and find an alternative growth path. And this is where we are working a bit in the EBRD, trying to refine, and this is a tailored approach, it's not something that will fit everyone. So country by country, I think in order to be credible, we don't only have to come with the negative story, which is be careful because, you know, this is hitting you, but trying really to offer some viable alternatives or at least productive ideas on how they could diversify into other segments. Maybe to finalize, some of the recommendations we've made in our countries, for those that are very rich in oil and gas, the management of their wealth funds is a fundamental tool for their long-term success. So these countries are building and they are sitting or should be sitting in very large amounts of money that they are collecting now through the sale of oil and gas, and it is very important that this money is actually kept for the purposes of supporting future generations and helping diversify away into other sectors. Many of these funds do not have clear rules on how the money is spent. So whenever there is a crisis, the government will use that money to fund short-term growth priorities. And we think there is a choice to be made there, whether they want to use the fund for short-term stabilization purposes or long-term growth paths. And maybe I leave it here.
Thanks so much, Isabel. It's really wonderful to hear some deeper detail of I think the narratives that make sense in lower middle income countries that are, you know, already have that carbon entanglement that we were talking about yesterday, but it's seen in a very different way. And I think what you're talking about is, from an MDB perspective, is helping a country to reposition itself in view of some inevitable trends, even though we don't know the exact dates, to reposition itself to optimize its competitiveness in that, you know, in view of those trends. And Baltazar will follow on from this quite nicely because he's looked across Latin American countries in view of a range of global demand scenarios, particularly in view of their competitiveness vis-a-vis their oil and gas regime, I think, and the public revenues raised from oil taxation and royalties. So, Baltazar, you want to...
Thank you, Glada. So my name is Baltazar Solano. I'm a senior research fellow in energy systems modeling at UCL. When the Inter-American Development Bank commissioned us to do this study about Latin America, I was quite excited about it, not just because I am Latin American, but because I think the timing is quite good. There is a cycle of elections across the region. Most countries are changing governments between this year and next. And so this is a good opportunity to inform the oil production strategies on the carbon risk and the fiscal opportunities that may arise under different scenarios. Now, besides the political uncertainty that will come with some of these new administrations, there's, of course, the uncertainty related to future global oil demand. And it is unclear how, for instance, a 2-degree world where large amounts of oil reserves might remain unburnable, how that's going to affect Latin American producers. And so the aim of this study is to assess the prospects of oil production in the Latin American region, and to determine robust fiscal strategies for these countries. So this is a model-based analysis. The main idea is to explore how global oil demand, how these three variables, global oil demand, tax regimes, and tax terms might affect the oil production and the tax income of Latin American countries. And so we are following this exploratory approach, generating many scenarios to see how, as you can see, many global oil demands we're taking into account, many different trajectories from IPCC, but also different fiscal schemes and different royalty rates and tax rates and so on, to see how that might affect the revenues of Latin American countries. To do this, we are using a model called BUEGO, which stands for Bottom-up Economic and Geological Oil Field Production Model. This model was developed by Christoph McGlade during his PhD at UCL on the uncertainties in the outlook for oil and gas. And well, in this reference below, you can find all the details about the model. But very briefly, basically the way it works is the model has a global database of about 7,000 oil fields with their economic and geological data. And so given a global oil demand, the model will choose which oil fields to develop and produce from to meet that demand based on the project economics at a given oil price. So if a project is too expensive, the model will not develop it in a given time period. Right, so I'm going to share with you some initial insights from this study. This project is still ongoing, and we're in the process of understanding how the different fiscal regimes affect the oil production of the countries and the revenues. But I will share with you some initial insights. So if we look at the Latin American level, if we look at the red line, the red trajectory, these are some modeling results from BUEGO. The red trajectory is the oil production of Latin America under a global oil demand that is consistent with a 3-degree world using the current tax regimes in the region. The blue one using a global oil demand that is consistent with a 2 to 3 degrees world, and the green one with a 2-degree world. So we can see quite a bit of difference in the oil production of the region. In the case of the 3-degree world, it goes up to nearly 14 million barrels per day, and in the 2-degree world, it stays roughly below 8 million barrels per day. And so we can see how different the trajectories are post 2025. Now, if we look at the dotted lines, I've used these global oil demands, but I've changed the tax regimes and the tax terms just for a couple of countries, for Mexico and for Brazil. And we can already see quite a lot of variation in the oil production of the region. Now, if we look at the sort of red trajectory and the green trajectory in a 3 degrees and a 2 degrees world, if we look at it at country level, we can see how different the production for Brazil in this case is the orange one. So let's have a look at Brazil, just as an example. Again, if we look at these modeling results, the trajectory in red, it uses the current tax regime in Brazil with a global oil demand that is consistent with 3 degrees, the blue one consistent with 2 to 3 degrees, and the green one consistent with 2 degrees. And now if we look at the dotted lines, that is changing the tax regime and the fiscal terms for Brazil. And so we can see a large variability in the oil production for the country. And obviously this means that tax income is going to be quite different depending on the scenarios. So from this we can see that the attractiveness to new investors and the optimal timing of investment in new projects is going to depend, yes, on the global conditions, oil demand, the supply strategy of OPEC, and so on, but also on the local conditions. And that is why it is key to allow for a robust and flexible fiscal strategies in these countries. And I would just like to make a couple of points already from this modeling exercise. One is, given the amount of variability and the uncertainty that we can already see, how important it is for oil producers, both countries and companies, to assess their carbon risks. And in order to do so, I would argue that you need to use advanced analytical tools that allow you to capture both the global dynamics, the complexity of the global dynamics, but also that allow you to explore the implications in terms of the fiscal regimes at country level. So I'm just going to stop there.
Thank you very much, Baltazar.
Sure.
I found that fascinating, and it definitely underscores the need of producers to be both engaging with this international discussion on carbon trends, carbon risks, but also for the international community to better understand, in more depth, the specific decisions that these countries have to make based on their geology, their particular type of reserves, the costs of that. There's obviously a lot of choices that they face in the next few years that maybe it's much more complex than saying either develop or don't develop. So now I'm going to turn to Vibhuti on quite a different issue. I think we've followed oil and gas for the last half an hour, and now we're going to turn to coal in one of the world's largest producers. I think India now produces about 10%, is it, of global coal production, and has become a significant importer as well. So really has an impact on the market dynamics, as well as there being very dangerous and harmful impacts playing out in country, and particularly in terms of pollution and damage to biodiversity around coal production. So Vibhuti, over to you to talk about the challenges of transition.
All of those who were missing discussion on coal as a fuel, so here I am now going to talk about coal. Most of you would be knowing, as Glada just mentioned, that India is one of the leading coal producers in the world, and is also, in order to meet its energy needs, it's importing huge amounts of coal as well as oil and gas. For oil especially, our reliance is as much as 90% on on oil imports. At present, the Indian government is earning huge revenues from both production and consumption, tax revenues from both production and consumption of fossil fuels versus the non-tax revenues, as well as if you compare it with the level of subsidies that the government is giving to such fuels, it's far, far much lower. That's in this scenario, if government who has been earmarking a lot of funds from both production and consumption of fossil fuels, but there is a huge threat in the sense because given the air pollution levels in India and on account of health problems that are becoming increasingly more prominent on account of respiratory diseases and other harmful effects on health on account of carbon emission, there is a huge strong pushback on the thermal generation side. In such a scenario, government will have to forego the kind of revenues they had been earning over the past so many years. So this is the situation which is likely to become more and more prominent during its transition away from fossil fuels. This is quite obvious if you'll see in these graphs how India's energy mix or the generation mix is going to change. This is the projection from the government, the National Electricity Policy, which kind of projects the share of generation mix till the year 2027. And as you can see clearly that the share of coal is declining and renewables increasing, but coal will continue to remain the mainstay of the energy mix in the going forward. I think another big area, as we've been talking about in this transition phase, employment becomes a key area of discussion. How would those people who have been relying on fossil fuels as an employment. India has Coal India, which is one of the biggest coal producer in India as well as globally. They have been employing more than 3 lakh regular employees as well as 1 lakh contractual employees. This share of total employment has already gone down over the last 2 decades because of mechanization, because of other practices that have been put in place, and less it's becoming less manual and more technology intensive. So from 6 lakh, like 2 decades back, it's already shrunk to about 3.5 lakh employment as a consumers in the coal sector. And however, these trends are changing. As per one of the WRI report, between 2017 till 2022, renewable sector in India would play a major role in providing employment generation to the tune of 3.3 lakh more extra employment generation that it would create. Coal imports have definitely, we saw a declining trend in financial year 2015 and 16 on account of increasing domestic production in India, but the trend is again on the upwards side. The value of total coal imports as well as the volumes are increasing again in India, and this demand for imports of coal is driven not only by thermal power generators, which to some extent has slowed down, but it's from other industries which demands higher grade of coal, which the India doesn't produce. So coal imports have gone up, and India can manage reducing its huge import bill by tapping more and more renewables, and the potential of which both solar and wind is huge in case of India. This big setup of thermal generation is on account of various government interventions which have played a big role in terms of supporting both coal mining as well as coal power generation. We recently did a study with ODI on the issue of stranded assets in India, wherein we mapped about the level of different government interventions which have led to coming up of these thermal power generation. So to the extent of 11.3 billion exposure of public financial institutions has led to support of the coal mining as well as coal power generation in India. $3.8 billion US in terms of policy postponements. When I say policy delays, it's basically India has come up with regulations in terms of complying of NOx and SOx emissions by thermal plants. However, it becomes a costly affair if they have to do retrofitting or change technology in order to meet those environmental norms. So as a result, there has been delays because already coal-based generation is under threat because the renewables costs have gone down substantially. And if they kind of incur these extra expenses, they'll become increasingly more uncompetitive. So as a result of these policy delays, 3.8 billion is the kind of support that the government has been giving to such plants. In addition, there is 2.1 billion in national subsidies on account of direct budgetary transfers and tax exemption. While the government interventions had led to huge setting up of coal-based capacity, but the matter of the fact is that India came up with oversupply, and as a result, we have seen that around 573 gigawatts of coal-based capacity. I mean, this would be more than demand of host of smaller European countries taken together. 573 gigawatts of capacity has been cancelled or shelved from the year 2010 to 2017 on account of various drivers, whether it's low demand because the financial health of the distribution utilities in India is in a poor financial state, or an account of fuel scarcity, whether it's coal shortage or gas shortage, and or it could be on account of air pollution or health issues, which has led to some of these plants getting completely shelved off or cancelled, or they are in operation, but they are operating at very low plant load factors. So that's the reality which India is currently facing. The exposure of the banks to such assets is huge. So in India, we are constantly facing this battle of how to revive these bad debts, because both the banks and the governments are under huge stress because their exposure is huge to the extent of 38 billion US dollars, which has led to like stress assets. So there are every month the government is taking stock of how these plants can be revived, at least this ones which already have fuel in place or which have PPAs in place, and the others are more or less likely to get scrapped, or they'll have to take a haircut and likely to get shut down in the coming months. One of the big reasons for these coal assets becoming stranded is what you can see, the declining trend of renewable energy prices in India since the year 2012. So you can see a sharp fall in renewable energy prices, and they have increasingly becoming more and more competitive. So it's now equally at par with the domestic coal-based generation in India. And this has led to more and more closures of such plants because the financial viability of coal-based assets is becoming hugely stressed. Just to end, as a result, that renewables has become cost of renewables going down has become a reality, and there is an increasing push by the government to set up more and more renewables. As a result, we have seen most fossil fuel dominated giants like CIL, NTPC in India, they have shifted and they're foraying into renewable energy space just to be relevant in the coming years. It's no rocket science in understanding that that's the way forward in India. And if they are continuing, they're going to continue to keep their reliance on fossil fuels, or they will lose their relevance, or they'll stop earning as much as revenues as they were earning in the past few years. And this is something which we have witnessed not only at the national level, so definitely these are big companies that are diversifying, but in India there is a big momentum which is happening at individual level as well. So what we see now, there are companies like Infosys, which is a big software company in India. They are trying to meet their energy needs or electricity requirement by setting up their own solar power, either at the offices or solar rooftop, or they're bringing in small solar plants to meet their energy requirement. So currently, Infosys meet 43% of its electricity requirement on its own, and is likely to kind of completely shift to renewable energy to meet its total energy requirement going forward by the year 2022. Similarly, we have Mahindra & Mahindra, which is a big utility vehicle group in India. They have committed to becoming carbon neutral by the year 2040. So that's the commitment which we are seeing not only from the national government, but the big industrial conglomerates which are shifting to meeting these RE targets on their own and becoming carbon neutral in the coming years. Realizing this, at IISD, we are definitely helping the national government in phasing out these fossil fuels and shifting to clean energy deployment, but we are also working at cities as well as even the small Zilla Panchayat level to help them, firstly, to meet their energy access goal, as well as to shift to meet their electricity requirements through more and more deployment of cleaner energy technology. So we are working with parliamentarians, we are working with other CSOs, we are working with a wide variety of stakeholders to get this impact on the ground. Thank you.
That was really fascinating. And I think I've changed my mind about some of the questions I'm going to ask, because I think in view of that, we should really concentrate on this issue of how producing countries' ambitions in transforming their economies and on putting their economies onto a green growth path perhaps conflicts with the previous development model and the their production and fossil fuel development strategies, and in view of that, look to maybe some of the assistance and some of the solutions that international assistance can offer. Maybe I could first turn to Isabel and ask to what extent you think that multilateral development banks can play a role in helping countries to set more robust fiscal policy and address carbon risk issues, and maybe whether you think they can work better if they move together. You all saw the World Bank's announcement in late 2017 about phasing out assistance to the oil and gas sector, but we didn't hear too much about what that really meant in continuing to assist countries with their development model in other areas, perhaps, and it would be good to hear whether there could be a more concerted strategy.
Thank you. I think most MDBs are facing the same pressures, and we are thinking about the same issues. I am aware of different development banks, the Paris Agreement commitments and sustainable. So there are a lot of sustainable development goals which tend to be followed by MDBs, not only climate change agreements. So that would be one of them. Depending on the MDB we are talking about, they place more importance on one or the other. The main topics are broadly the same. So, for example, there is a concerted effort from all MDBs, to my knowledge, to account and report on climate finance. And we've been repeatedly told that we need to increase the level of green finance that we provide in our countries of operation. Most, if not all, of the MDBs have targets for that. So we've seen an escalation in the number of projects that MDBs finance in this space. Depending on the mandate, for example, in our case, once projects become viable, normally we no longer invest in that sector because private sector can take the lead. And this is what is happening in renewables in many jurisdictions, that we are no longer needed, and therefore we are scaling back a bit in those countries. In others, I think we remain highly relevant because it is long-term funding, and not many private investors are willing to commit for 15 years. So we can gather different private banks or be shareholders in projects to give a signal that we believe in this type of business. So the diversification and one of the roles of MDBs, I think, is linked to promoting clean investments in countries, particularly when foreign direct investment is not very large in them. There is a reform advocacy that we can do, and I think most of us are consistent in pointing to the need to diversify away from fossil fuels, and there may be more or less emphasis on how we do that. Different MDBs have different strategies as to which are the sectors in which they invest or do not invest. So we do not invest in coal, for example, despite being very relevant in many of our countries of operation. In oil and gas, to be honest, we don't do so much upstream, which is where the World Bank has said they are going to stop. Actually, they didn't say they were going to stop financing. They said they would consider on a case-by-case basis and in exceptional circumstances. And I think the EBRD is more or less doing the same, and maybe the new energy strategy is under preparation, and one of the topics we are discussing actually is whether we follow the same rule, and we normally say we don't do upstream unless there is a very strong rationale for that. All MDBs need to conduct exhaustive cost-benefit analysis in which shadow carbon pricing is normally introduced as part of the analysis. So that gives reassurance also that some projects that increase emissions are maybe better than alternatives that may be proposed in that particular context. As to fiscal planning that you were asking me, or the fiscal aspects, one main weakness I see in all countries, but particularly in the countries in which I work, is the lack of long-term planning. So fiscal regimes normally go for periods of 1, 2, 3 years. Even the IMF has got 5-year frameworks. You try to find projections for long-term fiscal balances, and they only go up to 5 years. And the message we are telling them is that these things are going to happen in the next 5, 10, 15, and 20 years. So the political cycle is different than the fiscal cycle, and this is an added difficulty, I think, at the time of using active fiscal policies in these countries.
Thank you. I think that the need to adopt and institutionalize that long-term outlook is a problem for all countries. So something that we can all, try to work better together on. And it's a really interesting point about maybe the power of the development banks and other financiers in offering investment for infrastructure, particularly, the infrastructure related to oil, coal and gas development. And a lot of the special circumstances that Isabel mentioned, that say the World Bank or the African Development Bank might have in mind are around energy access. Can a project radically increase energy access to to poor rural areas, to provide more reliable power to cities, provide power to industry that can help a country develop. And so maybe we need to be thinking around much more thorough cost benefit analysis and evaluation of what the alternative could look like and how much that would cost before making the decision to lock in infrastructure that will last maybe 30, 40, 50 years out. I think Cleona actually touched on that point for Ireland, that they need to know exactly how 100% renewables could really work when there are so many questions about that. So I'm going to pose the same question to you, Baltazar, given your work with IADB. Maybe they're thinking about assistance in a different way, or whether you think this study might lead to any more concrete cooperation with the countries in question from your perspective, or any thoughts on how development banks might cooperate more to offer that kind of fiscal robustness that you're talking about?
Well, one area where I think we're lacking in Latin America in general is the capabilities to do analytical work for the governments. And one role that the development banks could have as well is to facilitate that those kinds of long-term efforts that require a different kind of vision to what usually politicians work with. So I've recently had an experience with the Mexican government where they made a huge effort to develop energy systems modeling tools to determine the energy strategy following the energy reform. And but they didn't really plan in a longer term. So now they have the tools, but now they need to learn how to use them and to have the capabilities, and just to continue with that ongoing process. And I think that is a role where the development banks could help.
Thank you. Actually, then it would be useful maybe to talk about a few of the findings from our work, Sian. We worked on this report very closely with the Department for International Development here in the UK, who supported our research, and through that engaged with a lot of other donors and development banks working in technical assistance. And we thought there were entry points for offering capacity building to help build that robustness. So maybe you can say a little bit about where you think efforts could be focused in the future.
Yeah, sure. I mean, I think one of the key points to make really is that certainly for the emerging and early stage producers that we've been speaking to and working with over the last couple of years, their choices look really, really different from those of more established peers, and they do have an opportunity to develop along a much greener pathway from the outset and really avoid some of the very difficult transition risks that Isabel and other colleagues are talking about. But in terms of the kind of compelling examples and the development pathways that are discussed in country, they're always the success stories of the last half a century or so. They're the Gulf economies, Trinidad and Tobago, Norway, and we know that these development pathways are not really available to countries setting out now. But changing the conversation really requires a sort of rebalancing and a resituating of the dialogue for a start, and really empowering other voices within government, particularly financial sector, economic governance actors, and long-term planners, and making the conversation about long-term structural risks. And certainly in that respect, central banks, ministries of finance, those who manage revenues have a really, really important role to play in terms of assessing the implications of energy transition for domestic financial stability, and that time frame for diversification, and also thinking about how revenues are managed in light of their vulnerability to fluctuations in price and demand, but also in terms of their potential to drive transition at the national level and potentially even support NDC implementation. And I think equally there are questions around the investment of longer term savings, so sovereign wealth funds. Is there an argument for following the sort of best in class strategies of the major sovereign wealth funds and long-term investors, and either reducing your exposure to carbon risk in international markets, or divesting altogether, so that you avoid this kind of double exposure to carbon risk at home and abroad. But obviously that's a huge technical challenge for these countries, and it requires new analytical capacity, as Baltazar has been saying. And it also requires a really, really long-term approach and real coordination between different arms of government. I think just to touch on one other challenge as well, that there's a tendency where exploration is concerned and where recent discoveries are made to take this kind of supply-led lens to national planning and think we have a resource, what can we do with it? Rather than thinking about national development aspirations and the energy services and the income that you need to deliver those. So again, thinking through more of a sort of demand-led framing and designing energy and industrial policy that gets the prices right, the regulation right, and delivers the right technologies and energy services to meet national development goals is really key. And certainly framing development discussions in terms of, oil and gas development discussions in terms of whether they actually support or undermine your NDC commitments, and also your ability to ramp up ambition over time to 2050, I think is really, really critical. But again, it requires new information, new capacities, and a really honest look at the trade-offs associated with different development pathways.
Thanks, Sean, and I think that very much links with what Isabel said about the management of sovereign wealth being key in this. And I suppose as we're thinking about transition, as we're thinking about moving from one model to another, we should also think about taxation. We should think about the ways that revenues gained from taxation, as well as sovereign wealth, might be redistributed into other parts of the economy to strengthen that and provide an alternative growth path. So maybe Vibhuti, you could say a few words on India's experience with a carbon tax levied on coal.
Sure. India levied this clean energy cess, which was the carbon tax in the year 2014, which they kind of doubled for a good 3 years till about 2017. And the primary objective was that the funds collected through this carbon tax or clean energy cess would be used for pushing more and more renewable energy deployment. And as I was showing in one of my graphs, that the prices of renewables, were way too high vis-a-vis coal, and as a result, not many electricity distribution utilities companies were ready to buy such costly power. So as a result, government used these funds as a viability gap funding for pushing more and more renewable energy. But given that now the prices have gone down, while the coal still attracts a carbon cess, it is no longer used for pushing or being used as a viability gap funding for renewable energy. Given now renewable energy is at par with the coal. That fund is now used for, other fiscal balancing, like they want to compensate states because last year India changed its tax regime from indirect taxes and, different taxes at center and state level to one unified tax called goods and service tax. And as a result, the states were losing a lot of money. So now that money is being used for making up losses for these states. So as a country, I think we have used carbon pricing and carbon taxation to promote renewable energy when it was required. But now this fund is no longer used. However, I strongly feel that given this fund should be more and more allocated for more technology innovation on the storage, because that's where now the key is. That's where the storage, because if renewables have to replace coal or fossil fuels altogether, so the storage is at the center stage. And that's where I think those funds can be utilized. But unfortunately, I think government is not using those funds for these purposes. Or it could be used for renewable energy integration, because again, that's a big challenge which India faces. A lot of capacity has been created, but because transmission is not available or integrating such variable power becomes an issue, that is also one of the bottlenecks which we are currently facing, and that has slowed down the pace of development, renewable energy push, which we were seeing in last few years.
So need for a much more strategic
Yes.
investment strategy for the carbon
Yes.
tax. Thank you very much. Now we have 20 minutes to open up to questions and comments. Please feel free. I know we've talked for a long time, so let's have as much debate as possible from you guys. So I think the gentleman over in the corner was first, and then the lady behind. Yeah, I know, I didn't catch them all. You might have to put your hands up again in a second, okay?
Thank you very much. My name is Roberto Schaefer from the Federal University of Rio de Janeiro in Brazil. I have one question for Baltazar. I found your presentation very interesting. It's very interesting, the use you gave to a global model. But my question, let's say, how comfortable you are in using a global model to derive conclusions for specific countries. The reason I'm saying that is because we also have our global model, but we only use our global model to set boundary conditions for specific countries. And then we run a country-specific integrated assessment model. We have a country-specific integrated assessment model for Brazil. It has more than 10,000 technologies for Brazil. We have very specific data for all oil fields, production costs, et cetera, and our results are completely different from the ones that you show. Completely different. We also have run, let's say, 2C scenarios, 1.5C scenarios, and we see exactly the opposite that you show, let's say. So my question is, how can you trust in a global model which is not designed to derive specific issues for specific countries? For that, you really have to rely on a country-specific model. Because in that case, you really have real data from specific oil fields, all investment that has been made. I'm just saying that because, again, the results you show are completely opposite to the ones that we have using a specific model for Brazil.
Three together, so there's a lady there and...
Hi, I'm Georgia Miller from the Sunrise Project. So this is a general question. We've heard a lot about entanglement between revenue and fossil fuel production, but I wondered if any of you could say something about entanglement between the politics of particular producers, government relations. How does this affect our ability to think about diversification? And to what extent should we be thinking about that as a real barrier too?
Good question. And the gentleman next to did you have your hand up? Or?
Just to add a point to Roberto information, because I'm too from Brazil and then work in the same lab of Roberto. I think most of the difference between our results, even for the global model and for the Brazilian model, relates to the quality of the oil. We should take care about the quality of oil because we have the refineries We have the demand, the oil products demands, and the quality of oil. And so, for example, now we are using more medium sweet oil. So if you are a producer of medium sweet oil, no matter the cost, oil refineries are looking for that because of diesel, because of bunker fuels. So we should think about refineries too. Oil is more complex than the case of gas and coal because we have these oil products, the more stringent qualities for oil products and different qualities of crude oil productions all over the world. So the quality of oil matters. And I think most of the difference perhaps comes from that.
Thank you. Great. So I think two questions for Baltazar there. And then I'll ask the others the question about political entanglement.
Sure. Well, thank you both. I mean, I'm happy to compare notes afterwards on the modeling to better understand what type of modeling you've been doing. I'm just going to say that we are not using a global energy systems model for this. It's a global oil field production model, so it has a very detailed level of economic and geological data, as well as the tax regime at country level for all of the oil producing countries. And it also considers the different oil types and so on. So it is not a forecast of, by any means of what might happen in Brazil. It's just playing with the project economics to try to understand on the different global circumstances and different local circumstances how the economics might change for the different countries. So it could be that Petrobras may have a completely different strategy, or Pemex, or Ecopetrol, or the Latin American companies. But yeah, I'd be happy to compare notes and see where you're coming from your paradigm.
And on the issue of the different quality of the oils and the markets for those oils, was that? Sorry, Baltazar.
Sorry?
Was that the quality of the oils and the fact that some may have a longer term market because of the refinery capacity and in importing countries?
Yeah, so we do take into account the different types of oils. I'm just thinking that they may be considering energy systems modeling at a country level, and so taking into account the entire energy systems model for the specific case of Brazil. Whereas this is an exploratory approach to consider many different scenarios with a global and with different global and local conditions.
So I think an excellent question up there about the entanglement of the political economy around high carbon interests, something that we've worked very closely on over the years. And of course, if the economy becomes very dependent on a source of rent, high rents attract a collection of people whose interests are vested in taking more rent. So there's a difficulty if you talk about moving to a different sort of diversified economy. So maybe some thoughts, I'll start with Vibhuti on that, on how you might start to shift those interests or some of the challenges that political lock-in presents.
Right. I'll just again take Indian example. On one hand, when renewables were picking up, at a very good scale, just like a month back, government came up again with a policy, or government announced that they would no longer allow prices to be quoted BM, because in India now all the solar bids are happening through reverse bidding auction. So people quote about what is the minimum price at which they can build these solar plants. So they put a cap, and which in today's market was very, very kind of a negative signal that went to these solar developers while everything was good. Given that the rupee devaluated, the depreciation has led to, and given that currently most of the modules are imported, so which had led to higher costs for these developers. And on top of that, with government capping the prices, it wasn't setting a right signal. So I think while there was a big push and there is a big target of 175 gigawatts of renewable energy by the year 2022, but such policy uncertainties and such political, announcement again brings a lot of hindrance. On the other hand, we had an example in one of the big states in India, in Orissa. While I talked about there is huge stranded capacity of coal base in India, which is to the extent of 44 gigawatt, given that the elections are around the corner and India is going to have a national election in the year 2019, one of the oil and gas minister is pushing NTPC to announce a 1,000 megawatt project in his state, which is any economic, on any financial or on any environmental ground, that project does not make sense. When you already have 44 gigawatt of capacity which is there and which is not being dispatched, and you are asking NTPC, one of the big public sector coal producing developer in India, to put up another 1,000 megawatt capacity. So these are some of the challenges, the politics do drive some of the decisions at times, and which is much more difficult to handle than, the issues related to integration or the issues related to, as I said, storage, which are more manageable in terms of, that's the technology which we have to work through. But managing the political economy becomes very, very challenging at times.
Definitely need for much more work on that and concentration on that. Maybe just a few words, given that we did think about this issue, and Sian mentioned that there needs to be more work from an international perspective with the ministries of finance, as EBRD is doing, with the central banks, with the national planners, which maybe shifts the emphasis away from a narrow set of interests.
Yeah, I think, it's a well-known phenomena, this sort of crowding around of industrial interests and other actors around the perceived, advantage that access to low-cost resources can provide them with. And obviously that crowds out other sectors of the economy, and particularly more innovative, broad-based economic activities. I think a lot of it is to do with the incentives, the structures that are built in from the word go, and I think this is something that we have been discussing in relation to the actors that operate in the upstream fossil fuel sector, the ministries of energy and particularly national oil companies. They can act as a kind of driver of transition or an active barrier to transition, depending on the kinds of incentives that are built in there. And I think there's an open question around their appropriate remit through the energy transition. You can certainly see the change in the tone of questions in country over the past couple of years, where we now have emerging producer NOCs asking us, what does an appropriate strategy through the transition look like, and looking at companies like Saudi Aramco and others and saying, should we be developing our renewable capacity? Should we be moving into other sectors of the energy industry? And obviously there's a really strong political argument for that, where you're sort of looking for your survival and your role in government over the longer term. But there are questions about whether those institutions are the appropriate home for renewable technologies.
So I think we're going to cover that in the
yes,
session
sorry, Sheila
on Sheila's
is going to be
session
talking
on
about that this
NOCs. So I will not hijack her session. But yes, all really, really interesting points. Now, we had a question from the gentleman there. We had one from just behind. There's quite a few. Let's try and take them all together, because I know we have. I'll ask for your hands again. I think I've got one there, one there, one there. And then just show to the lady with the microphone, and then 3 up there. Okay, great. Go ahead.
Okay. Thank you for a very interesting presentation, a set of presentations. My name is Jakob Skovgaard. I'm from Lund University. My question is to Sian and Isabel. What you said about these kind of local pollution concerns kind of echo and resonating more with finance ministries, energy ministries, planning ministries, made me wonder whether, and that was kind of echoes what we heard previously yesterday, whether the UNFCCC and the Paris Agreement really is the right venue for promoting climate change in such countries, fossil fuel producing developing countries. So my question is, are we perhaps better off promoting climate change within the context of the SDGs or a third kind of institution?
And behind. Thank you.
Good morning, Kia Kühne from Lingo. I have a question for Isabel about the EBRDs energy sector policy review and fossil gas. We very much appreciated the EBRD stopping to finance coal, but we were dismayed at seeing the support for a project like the Southern Gas Corridor, which is bringing more fossil gas from Azerbaijan and Russia into Europe, where Europe is looking downwards with its demand. After the Paris Agreement, we assume that the governments, which are your shareholders, would be committed to the Paris Agreement. So any support for projects should be checked against the Paris Agreement, and not only the NDCs, but also the temperature targets. I don't believe that has happened for the support for the Southern Gas Corridor, but I think the energy sector policy review is an opportunity to set that straight. And I think if you've studied Greg's work on the sky's limits, there we have some ideas for which way that could go. So I was wondering whether there is anything that we here could do to facilitate the EBRD being progressive and a leader in that sector, because the MDBs have to be leaders in that sector.
Yeah, I'm Paul Mollett from CapSarc. Just a comment echoing something that Isabel said. We got two lines of work. One is the future of oil in the energy transition, and then a completely parallel track on the next likely NDCs that countries will declare. When we go to India and China, it's very clear that they're not really interested in carbon emissions at all. They're only interested in air quality, and carbon is almost a co-benefit of pollution control.
And there are three up at the top, so let's take them all together.
Ron Steenblick, OECD. I just have a question for those who are actually engaged in talking with the countries about these issues, particularly Isabel. When you are trying to present a picture of a future with these kinds of constraints, what do you say in terms of the likely leverages that will be used at the global level? Because I mean, at the moment we have targets, but they're unenforceable. So are you thinking that there will? Are you saying to these countries, well, we expect there will eventually be some kind of binding targets, or carbon tax? Are you imagining that the importing countries will just simply stop demanding the products? Or are you imagining something like a border carbon tax adjustment? So, because that part of the discussion seems to have been missing from here. You know, how is this actually going to happen?
Hi there. Thank you for seeing me. My question is for Sian and Isabel. Around developing countries' sovereignty over their resources and bilateral investment treaties, particularly the Energy Charter Treaty. Do you see any risk in from investor-state arbitration for countries electing not to develop fossil fuels, perhaps in circumstances where they've already provided permits or so forth to do so? Just whether or not you see bilateral investment treaties as a threat to developing countries' sovereignty over their resources and their ability to pursue a greener development path.
Was that?
Good morning, Roman Mendelevich, my name, from Humboldt University. My question is to Vibhuti. I was surprised to hear that Coal India Limited is also involved in developing renewable resources, and I would be very much interested to hear more about it, as we see from European big utilities who had big struggles to develop a fossil and a renewable sector at the same time, and in the end, got bankrupt about it. And
Thank you very much. We'll probably have to save some of these for the break, but I think the best thing to do when we have 1 minute left is give each of the panelists a chance to answer the question that they want to answer. Sorry, that's a bit of a cop-out, but I want to stay to time. Okay, so maybe I start with you, Sian. Maybe you want to say a little bit about the constraints that we're imagining in terms of what the energy transition means for fossil fuel markets. But again, you can always ask Steve Pye as well in the break, because he helped us a lot, obviously, doing the modeling for this study on what those constraints might be. But we're talking about a range of push and pull factors.
Yeah, I mean, to be clear, I think we're taking obviously we've done the modelling, Steve to carbon budgets, temperature degrees, but we're open as to the drivers of stranding and of reaching those carbon budgets. And in reality, it will be a combination of top-down signals, climate policy, repricing of resources, taxation, but also demand drivers and the emergence of new technologies. And we can see just over the last few years how obviously the price of renewable technologies has far exceeded expectations. And we can see similar trends taking place where batteries and EV projections are concerned. So I think it's a push and pull. It's a combination of both.
Thank you. And Isabel, would you like to say something about EBRDs gas?
Okay, there were a lot of questions. On local pollution concerns and whether it makes more sense to speak about SDGs rather than the Paris Agreement itself, what happens is that there is a more international push, at least in the space of the MDBs, to comply with the Paris Agreement, which is a concrete target on climate change. While the SDGs, I think they are 17, very diverse, more difficult to track. So in the EBRD, we started with the Paris Agreement, which is also where there are clearer plans on how countries are going to implement and how all these things are going to be monitored and so on. And we are developing in parallel the narrative for the SDGs. So it's not that the EBRD only does investments if they fit into the Paris Agreement or consistent with the Paris Agreement. I would say it is more prominent, but we are mapping, and there are co-benefits like local pollution and CO2 emissions. So I think multilaterals are making an effort in supporting SDGs, and some will be more relevant than others depending on the mandates of our respective mandates. On the Southern Gas Corridor project that you were mentioning, I'm not into the details of the project itself. It is a sort of a one-off project, to be very honest. And the driver for that very big investment was not green or primarily green. It was linked to energy security issues. That was the thing. Diversifying the supply from Russia and bringing it from other countries. It was very well covered by the media, very controversial. Just to say that it was not only co-financed by the EBRD, the EIB co-financed a bigger share, and the European Commission pushed strongly for it. There was a cost-benefit analysis. What happens with the pipelines is that most of the emissions are Scope 3 emissions, so it's not the pipeline itself that creates the emission, but the lock-in and the use in the long term of gas resources. This particular project goes to many places. So we thought in places like Turkey, for example, where they are building a lot of coal, the rationale for lock-in was less clear, because we think the alternative scenario may rely more on coal. In Europe, it is much more nuanced because the renewables, particularly in the power sector, we think this is where the future will go. So all this to say it was a complex project, a sort of one-off, given the political context as well. And the new energy strategy will need to tackle, maybe not on concrete projects because we don't know which ones they are going to be, but which are the characteristics and the variables we would look in detail when deciding whether or not to approve such a project.
Thank you, Isabel. Just for time, just Baltazar and then
I can
Vibhuti.
take bilaterally some of the other questions.
If I may just say one last thing, is that carbon risk is not high in the agenda in Latin American countries. Latin American governments are quite concerned about declining oil production, but they're more worried about the financial situation of the national oil companies than about unburnable oil. I mean, if you Google the term riesgo de carbono in Spanish, it won't even appear. I mean, there may be a couple of Spanish references, but it's not something high in the agenda. So I guess we just have to bear that in mind when we engage with these countries.
Thank you. It's an interesting point. Vibhuti.
Just responding to the question of why, how the public sector companies are diversifying. Given that they are public sector companies, so they do get preferential kind of, treatment from the financing companies because there is a government who is like backing these investments, as well as they are able to get the required land easily. So and given that the technology is now very much developed, so they're finding it less risky a proposition. And given, as I said during my presentation, if they have to be relevant, they have to diversify. So I think that's the guiding factor for them. And given they are getting lands and finance at the preferred rates or at reasonable costs, so they are able to push that kind of a diversification much more easily than any private sector companies.
Thank you very much. I want to say thank you to our panel before we go for coffee. Thank you so much. I think it's a really rich and fascinating discussion.